So similar to the way that we had a GDP formula, there's also a current account balance formula, which falls within our international trade and capital flows topic. And the current account balance, or abbreviated CAB, includes our goods and services that are traded between nations, our income flows, so dividends, interest, stuff like that on loans that we either receive from other countries or that we are giving to other countries, as well as unilateral transfers. So this is things like aid or products, goods, and services, the value of those that we're sending to other countries. And the formula for your current account balance is exports minus imports plus net income plus net transfers. And we're going to use that formula as we look at the next three examples and calculate if there is a surplus, meaning that there is a positive value in the current account balance, or a deficit, meaning that there is a negative current account balance. If there is a surplus, that means that we are lending to other countries. And if there is a deficit, that means that we are borrowing money from other countries to pay this balance. So keep this in mind as we look at our three examples. So our first example, we have that our exports are 500 billion, our imports are 600 billion, net income is 20, net transfers is 10. What is the current account balance? So recall that our current account balance equals exports minus imports plus net income plus net transfers. So if we use this information, we know that our exports are 500. So 500 minus 600, because that's what our imports are. Our net income is 20, so plus 20. And our net transfers is 10, so plus 10. Negative 500 minus 600 gives us negative 100 plus 20 plus 10 gives us negative 70, and then we're looking at billions of dollars. So the current account balance for this country is negative 70 billion. Since it's negative, that means that this country that we are looking at is running a deficit, meaning that we are having to borrow from other countries So we have another example. And again, we're given the same type of information and we're asked to calculate the current account balance. And the current account balance is going to be exports minus imports plus net income plus net transfers. So our exports are 850 billion, so 850 minus our imports, which are 800. Our net income is 30, and our net transfers are negative 10. So 850 minus 800 gives us 50, plus our net income, which was 30, plus our net transfers, which was negative 10, which gives us positive 70. So our current account balance for this economy is a positive $70 billion. Since it's positive, that means that there is a surplus in our current account balance, meaning that we are giving loans or providing lending to other countries. Then one last example. Again, we're given our exports, our imports, our net income, and our net transfers. So our current account balance is going to be equal to exports minus imports plus net income plus net transfers, which is going to be 700 minus 750 plus negative 25 plus negative 15. So 700 minus 750 is going to give us negative 50 minus 25 minus 15, which gives us negative $90 billion. So negative 90 billion. Since it's negative, that means that the country is running a deficit. And I misspelled that. My apologies.